almost everybody unanimously believes that NBFCs in particular, and maybe banks as well, are a sure shot candidate for returns over the next 12 months, considering all that's happened in the last 6 in the new RBI. Would you beg to differ, or would you concur?
Okay, Neeraj. So first of all, yes, I have always been a nervous investor in banks and lenders. And in my recent column in Mint, I had set out why. But as I had written at the end, this is probably the time I have been most positive on banks in the last 3 years. So if you look at the last 5 years from 2020 to 2024, so the bank Nifty underperformed the Nifty in 2020 when it was the only sector in the negative, in 21, in 23, and 24. So the only time that bank Nifty outperformed the Nifty was in 2022, which is when we were market weight on banks too. And while we are still not market weight, but both in our January rebalance and April rebalance and a little bit thereafter also, we've been increasing our exposure to banks. So, I mean, they've spent a long time in the wilderness. So I think, definitely that is one of the sectors that is looking better. I think that's among the major sector indices. That's the only one that is higher than where it was in September. But you talked to the RBI. I mean, I find it a little funny because, when the RBI raises rates, that is when the margins for banks go up. Because what happens is that the loans or the asset side, basically the new interest rates comes into effect more or less immediately. Whereas for the deposits, the rates go up only when the deposits come over for rollover. So that the margins actually expand on the other side of the cycle. So, I mean, often it happens that whatever the RBI does, for some time, the headline is that it is good news for banks. So the rates go up, the margins will go up. If the rates go down, the credit cycle will revive, etc. But that's how, I mean, of course, RBI has this time softened the blow, so to speak, by also reducing the reserve ratio so that the banks can actually lend out more. But ultimately, the demand for credit, I don't think really changes with a 0.5% or 1% interest rate. So if a company is not going to do, let us say, capex, it is not going to start doing it because the rates are 0.5% lower. So that part is, and there are still risks. I would not say that go all out and buy lenders, because I think on the retail credit side, there are definite risks. And also you talked of banks and NBFCs or so-called, fintechs and this and that. But you have to be careful because often the NBFCs are lending to people whom banks will not lend to, people or entities. So they are usually lower down in terms of the credit quality. So often the first signs of stress come there rather than the banks. So those are the things to keep in mind. So it's not like just go out and buy any lender, but definitely the banks are looking a whole lot better than, as I said, definitely they've looked in 3 years.